Let me first thank all the organizers, both for the invitation. It's really an honor to be kicking off this series, but also just for taking the initiative to put together this colloquium series. I think it's you know, the blockchain space, there's people in so many different areas, you know, all over the world. So it's really cool to have this venue where we can kind of get together and share what we're up to. I certainly plan to attend, you know, as many of these 8 weeks as I can. So super excited that this is happening. And today, so thanks for joining me. I wanted to tell you a little bit about the past and future of the transaction fee mechanism in Ethereum, and more broadly, bringing in tools of mechanism designed to reason about how transaction fee mechanisms should work in blockchains. Let me just first take a step back and let me just sort of review, you know, why do we even have a transaction fee mechanism in blockchains like Bitcoin and Ethereum? You know, why do we have them? What do they do, et cetera? And when you have a big successful blockchain like Bitcoin or Ethereum, you have this sort of, you have a problem. It's the problem you want, but you have the problem that that space, real estate on the blockchain is a scarce resource, in the sense that demand for that resource far exceeds the supply. So, for example, on the Ethereum network, EVM, Ethereum virtual machine computation, there's many more people that would like to sort of get access to that EVM than can. So by supply here, what do I mean? Well, you know, just focusing on Ethereum, you know, as many of you know, there's periodically a block on average every 13 seconds. And the blocks have a maximum size. Size here is measured in gas, which is a proxy for the computational and storage cost required by a transaction. So every 13 seconds, a 15 million gas block is published, and that's enough for, of the very simplest transactions, maybe roughly 750 of the very simplest transactions. More complex transactions take a lot more gas. Point being is there's only so many transactions that are going to get executed in a given period of time in, say, the Ethereum network. And you know, again, if everything was sort of free, if people, you know, if people could, they would love to. Many other people would love access to the blockchain as well. And so, because of that, because you have sort of demand so much higher than supply, you know, that means you have to pick a subset of the pending transactions to be included on chain. Okay? And so the question is then, you know, who do you want to go on chain? If not everybody can go on chain. And a natural approach is to look for economic efficiency, which basically means you want to allocate the scarce resource to those who derive the most value for it. So you would like to have transactions that generate a lot of value be the ones that are included on chain. And for example, low value spammy transactions, those are the kinds of transactions you'd like to be excluded. And that's exactly what having transaction fees allows you to implement. So by having transaction fees, if I am sending a high value transaction into the Ethereum network, I can signal that it generates a lot of value for me by offering to pay a significant transaction fee for its inclusion. Whereas, you know, those who create low value transactions would not be willing to pay a non-trivial transaction fee. Okay, so that's really the point of the transaction fees. It's not to generate revenue. It does generate revenue, but it generates revenue really as a byproduct of what we really care about, which is allocating the scarce resource of space in the blockchain in the most economically efficient way to the transactions deriving the most value from it. Okay, so that's why at a high level we have transaction fee mechanisms in blockchains to mediate the excess demand and identify the high value transactions. Okay, so how does it work right now in Bitcoin, Ethereum, and many other blockchains? Well, it's what people tend to call a first price auction, which means basically you pay what you bid. Okay, so when you submit a transaction to, again, I'll use Ethereum as the running example. You submit a transaction to the Ethereum network. The user, or you know, more likely a wallet on behalf of the user, attaches with that transaction basically a bid. Okay, so an offer to pay a certain amount in Ether for that transaction to be included. Then blocks, of course, are assembled by miners. You know, currently, Ethereum is proof of work. So you know, it's someone who got lucky and solved this sort of difficult crypto puzzle. But in any case, a miner, the winner of this lottery, is sort of has dictatorial control over how it assembles its block. It can include whatever transactions it wants, and you know, presumably it's to maximize revenue, though it can do whatever it wants. And then, you know, whatever the creators of transactions offered to pay for transaction inclusion, well, then they pay it. Who do they pay it to? They pay it to the miner that included their transaction. Okay, so that's how things work today. First price auctions, every transaction comes with a bid. Miners include whatever they want, and those bids get transferred from the creators of the included transactions to the miner of that block. Okay, So that's what, Satoshi had in the original Bitcoin white paper, and it's basically just sort of copied wholesale for Ethereum, and has been in many other blockchains. Super natural place to start, but they're not without issues, these first price auctions. So in particular, this has been known for a half a century in lots of different contexts. It's really hard to figure out how to bid in first price auctions, okay? And the reason is because you have to reason about what other people are doing. So, in a first price auction, you kind of would like to bid as low as possible, subject to you actually getting included in the block. But low as possible, that means you still have to beat out all of your competition to get in the block. So you have to sort of guess, make an educated guess about what the creators of other transactions are doing. And that's a difficult thing to pull off. So for example, just to make this concrete, I'm sure many of you have used Metamask, which is one of the most popular Ethereum wallets. And if you go to the advanced tab here, you can actually set exactly whatever bid you want, whatever gas price you want. But for those who are not sort of power users, there's these gives you this simple menu of 3 options. In effect, it says here, it's like, if you want your transaction to be in the next block or two, pay $22. Or if you're happy to wait, 30 to 60 minutes, feel free to just pay $17. So, very smart people at MetaMask are working hard to try to suggest reasonable numbers, trying to come up with a good algorithm for estimating, what you should bid for entry in the next block as a function of historical data. But anyone who's a regular kind of Ethereum user knows that apparently, even though there's lots of smart people working on it, that's a really hard problem. Because many of us will have had the experience where maybe you even click fast, you even say you're willing to pay $22, and then the transaction just hangs. It's just pending for 30 minutes or more, because the competition suddenly got much stiffer right around the time that you were submitting your transaction. So it's a real thing, this difficulty of fee estimation, right? So it's certainly difficult to do it yourself as a user, and even the wallets are probably not doing that great a job. Okay. And so those first price auctions, and that's the big difficulty with them. It's just, so it's really kind of a user experience critique. It's just sort of hard to figure out what to bid. And if you screw up your bid, you may have your transaction, you may overpay by a lot, or you may underpay and then sort of have your transaction wait around for a long time. And so, for a long time, people have been wondering, could you do something better, right? Could you have some kind of transaction fee mechanism which places less cognitive burden on users and their wallets, where it's just sort of much easier to figure out what you should bid, okay? Some of you, I hope most of you have at least heard of the idea of a second price auction or a victory auction. So that's a single item auction where the highest bidder wins, but only has to pay the highest bid by somebody else. So only has to pay the second highest bid overall, as opposed to their own bid. And that's an example of a truthful mechanism, meaning that it's a dominant strategy for the participants to just say what their maximum willingness to pay is. So in other words, in truthful mechanisms like second price auctions, there's literally no need at all to reason about what other people are doing. You do not care who you're competing with. You do not care what your competitors are doing. You should just be honest with yourself about what you're willing to pay and submit that as your bid. It's guaranteed to be the right thing to do. So that sure sounds a lot easier than a first price auction, right? So a natural question would be, could we have sort of the ease of bidding in a second price auction, but in a blockchain context? Right? So that's a natural question, and I'll say a lot more about that. Just at the outset, I want to say that in addition to, I think, being a basic scientific interest, this question really speaks to sort of a huge debate that's been raging in the Ethereum community, in sort of maybe second half of 2020 and so far in 2021. And it concerns an Ethereum improvement proposal number 1559, EIP-1559. And this is actually a web search from several months ago. Okay, now it's closer to sort of 1 million results if you search for it. You can also see the news articles here sort of refer to some kind of polarizing aspects. So we'll probably return to that later in the talk. But in any case, there's this, what is EIP-1559? It's a major change that's being proposed to Ethereum's transaction fee mechanism, which the plan is to have it deployed in the London fork, which is scheduled for July. Okay, and literally the origin story of EIP-1559 is exactly what I just told you. It's exactly to sort of make setting computing transaction fees much easier than it is today with first price auctions. Okay, so the sort of general sort of framework I'm going to be discussing, I'll tell you sort of in general. some formalism for how we might assess different transaction fee design proposals. And then in the second half of the talk, we'll apply that framework specifically to the proposal in EIP 1559. Okay. All right. And so, because 1559 is such, I mean, really, if it gets deployed, it's going to be the biggest economic change made to a major blockchain to date. Okay, there's been, I mean, it's really kind of it's a big deal. So there's been a lot of discussion, a lot of hand-wringing, a lot of concern. So, for example, late last year, they did sort of a community survey. So they went to a bunch of different stakeholders in the Ethereum community, so people who write clients, people who run mining rigs, et cetera. And they asked everybody, how do you feel about 1559? Should we do it? Should we not do it? What obstacles would we have to overcome to get your buy-in? Okay. And there are several things, but what I wanted to highlight here is one of the top responses was that a concern to EIP 1559 was the lack of a formal specification or proof for the mechanism that people can independently evaluate and critique. Okay, so the byproduct of the work I'm going to tell you about is exactly such a formal analysis of EIP 1559, okay, which again can be applied to other transaction fee mechanism designs as well. All right, so let me just, maybe I'll do a quick pause, see if there's any urgent questions. Otherwise, I will continue talking about the necessary mechanism design background that we need to sort of interrogate the properties of EIP 1559. Okay, I see something in the chat. Okay, so no questions yet, looks like. Okay, great. Then I will resume. So what I want to talk about now, right? So I come from a mechanism design background, and one thing that's really interesting about this problem is mechanism design for blockchains is not like kind of our parents' mechanism design theory. There are idiosyncratic constraints in permissionless blockchains which force us to really revisit tried and true mechanism design. And so in this next part of the talk, I want to highlight that. I want to highlight kind of what are the new wrinkles in mechanism design that we need to actually say something meaningful about, say, transaction fee mechanisms in Ethereum. Okay. So earlier I mentioned about these second price or victory auctions, right? So where the winner pays the second highest bid. I said how they're truthful. Okay, so meaning that you don't have to reason about what other people are doing. You just submit your honest maximum willingness to pay. The mechanism design jargon for that, okay, for like a victory auction, is dominant strategy incentive compatible, or DSIC. So whenever you see DSIC in this talk, that just means truthful. It just means users are motivated to bid their true valuation, their maximum willingness to pay. So a question we asked earlier that I want to now sort of take up in earnest is, we've got the victory auction. Granted, that's just for selling a single thing, and we're selling kind of space and blocks where you might have, say, 600 transactions or something. But maybe is there some way we could generalize the victory auction so that it applies to allocating block space and still has this nice truthfulness property? And you ask anyone who's taken, a first course in algorithmic game theory, that question will be like, oh yeah, sure. Yeah. No, I mean, there's this famous generalization called the VCG mechanism. It's not important that for this talk that you know what this is, but it's just a far-reaching generalization of second price auctions. And so, yeah, we could just, someone trained in traditional mechanism design would say, yeah, just use the VCG mechanism, or if you don't want to if you want to work a little less hard, use less computation, you could use a greedy approximation algorithm, just sort of pack a block in order of transactions gas prices, and charge a suitable price to make that truthful. That would be fine. So why isn't this a solved problem? And you might also, I mean, if you think about it, you've probably never heard about second price auctions in the context of blockchains. And you might be wondering, like, why is that true? Right? Why don't we ever hear about second price auctions? So let me tell you what it is about blockchains that really prevent us from using second price or VCG type mechanisms. Okay. All right, so here's the traditional formalism mechanism designers use to talk about auctions and mechanisms. Okay, they sort of separate out the decisions, they separate two different types of decisions. Okay, so first, who gets what? Okay, that's called the allocation rule. So that's like choosing which of the pending transactions get included into a block. Okay, who gets what, who gets included, who gets excluded. And then decision number two is who pays what. Okay, so for example, in a second price auction, the first decision is you give it to the highest bidder. That's the allocation rule. The second decision is you only charge the winner the second highest bid. That would be the payment rule in a Vickrey or second price auction. And more generally, you can play around with different allocation and payment rules, X and P. All right, so what I want to do next is identify 4 challenges, okay, which are unfamiliar to the traditional mechanism designer. So this is challenge, I've listed challenge 0. This is a very familiar challenge. That's why I'm not calling it one of the main 4, which is that, you may wish that users would sort of reveal true information to you, like what they're really willing to pay, but they don't have to, right? Users can do whatever they want. They can underbid. If they want to, they can overbid. They can submit whatever they want. All right, so you want to set up the incentive so that they're motivated to give you accurate information. Okay, but that's the usual challenge right in the wheelhouse of traditional mechanism design. Now, let's get to something which is quite different, right? Traditional mechanism design, I mean, an application there would be like spectrum auctions, right? So like the US government or the Swiss government, they regularly run, and many other countries regularly run auctions that allocate licenses for use of wireless spectrum, for example, to telecom companies. And, that mechanism is run by a trusted third party, basically, right? So the government basically runs that auction, and kind of the participants are basically trusting the government's going to run the mechanism that they said they were going to run, okay? And that's obviously, there is no trusted third party in a permissionless blockchain, right? And again, say in Ethereum, like there's literally just this miner who, once it solves its, crypto puzzle, it can really put its block together however it wants, okay? It has dictatorial control over the allocation, over which transactions get included, okay? So the untrusted miner can mess, you may have an allocation rule X in mind, but the miner can implement whatever allocation it wants. Now, the good news is that the payment rule is different. The payment rule P in sort of a blockchain protocol, that's gonna be hardwired into the protocol's code, right? So like in Bitcoin and Ethereum today, it is hardwired that when a transaction is published with a given fee, there is immediately a transfer of that fee from the creator of that transaction to the miner of that block, okay? And there's no way a miner can sort of make that number higher or lower or manipulate it in any way. So miners can manipulate the payments only in as much as they can choose who's in the block, only in as much as they can manipulate the allocation, okay? So at least we have that going for us. All right, so now let me actually answer why don't we use truthful mechanisms like the VCG mechanism. I want to first just mention kind of a very small issue, which is easy to overcome. And then on the next slide, I'll tell you the real reason you never hear about second price auctions in permissionless blockchains. All right, so the first sort of niggling annoyance is that, right, so somehow payments should be computable by purely on-chain information, right? So for example, if someone spins up a new full node, right, they have to sync with the history of the blockchain. And so they have to basically look at everything that's happened and sort of figure out, for example, people's account balances. And people's account balances, for example, are going to depend on what transaction fees they paid in the past, okay? So it's important that, however you define the payments, they only reference stuff that's on-chain, as opposed to, say, pending transactions in the mempool that have not been included on-chain, okay? And think about a second price auction, right? So where the winner is the highest bidder and the payment is the second highest bid. Well, you realize actually that outcome is, that payment is not going to be computable from on-chain information. The winner is included, so you see the winner's bid, but you have no idea, unless you were monitoring the mempool at that time, you have no idea what the second highest bid was, so you have no idea what a second price auction would have charged that winner, okay? So that's an immediate obstacle that, we have to actually use restricted mechanisms with the property that the transaction fees, the payments depend only on on-chain information and have to be independent of the excluded transactions, okay? And so technically that does rule out sort of the second price auction and more generally the VCG mechanism where payments do depend on the losing bids, okay? So again, so the only difference we're going to make here is we're just going to restrict sort of the domain, basically the payment rule, to reference only kind of what's on the block as opposed to everything that's in the mempool. All right, but this is, frankly, this is not a big issue, right? If it was a single item auction, it would be a big issue, right? Where there's no way we'd know like what the second highest bid was. We'd be clueless. On the other hand, Ethereum blocks say they have hundreds of transactions, right? So for truthfulness, what you'd be interested in, if you include 300 transactions, you'd be interested in what was the 301st highest bid, so the highest losing bid. And again, you don't know that, but you do know the 300th highest bid, which you figure is probably a pretty good proxy for the 301st highest bid. Okay, so that's basically, technically you lose the truthfulness property a little bit, but it should be basically just as good. Okay, so that's why this sort of computability from on-chain information only is not the major obstacle. The major obstacle is not only does we said a miner has dictatorial control over its block, and so that means in particular it can make up fake transactions of its own and include those transactions in the block, okay, if it so chooses. And this has also been observed in previous alternative transaction fee mechanism designs, okay? And a miner can really do this in an undetectable way, okay? So if a miner could boost its revenue by including fake transactions, you really have to expect that they would do it, right? There's really no downside given that they can do it in an essentially undetectable way, okay? So that's a problem. And then this is where sort of VCG type, second price type mechanisms go horribly wrong, okay? So maybe just a quick example, a sort of toy example, suppose we have 3 transactions, we have room for all of them in the block. Let's suppose they had bids of 10, 8, and 3, okay? So the honest miner, right, who runs this sort of variant of the Vickery auction where you use the lowest included bid as a price for everybody, the honest miner is supposed to include all 3 of these transactions, in which case it's going to be charging the lowest bid of them, 3, to each of the 3 transactions, generating a revenue of 9, okay? That would be the approximate version of the VCG mechanism that we discussed. But if I'm this miner, right, why don't I just sort of make up a new transaction, okay, where the transaction fee is 8, and then I'll include the block, in the block, the real transactions 10 and 8, and the fake transaction that I created with bid 8, okay? So that's now the common price charge to everybody is 8. You're gonna get 24 revenue. Of course, 8 of that you have to pay yourself because it was your fake transaction, but still your revenue is gonna get boosted to 16, okay? And there's lots and lots of examples like that, okay? So miners, if you try to implement a VCG mechanism, miners are heavily incentivized to manipulate it through fake transactions to boost their revenue. And this is the reason why you really never hear about second price auctions in permissionless blockchains. All right, so we're going to be having 3 definitions, 3 incentive compatibility guarantees I'm going to be interested in investigating. One we already talked about, which is truthfulness, or this dominant strategy incentive compatibility property. So that was number 1. Here's number 2, motivated by these challenges that we've seen thus far, okay? So we're going to call a transaction fee mechanism MMIC, okay, which means incentive compatible for myopic miners, if miners don't have these incentives to mess around with the mechanism. Okay, so if a miner is happy to follow the intended allocation rule and is happy to not insert any fake transactions, okay, that's what we mean by MMIC. So as we've seen, second price type auctions are not MMIC because you are incentivized to have fake transactions. And if you think about it, the status quo first price auctions, they are MMIC just kind of trivially, right? So when you deploy the first price auction, what are you sort of expecting miners to do? You're expecting them to pack the block as full as possible with the transactions that have the highest fees. Well, that maximizes the miner's revenue, so the miner is totally happy to do that. And there's no reason for the miner to include any fake transactions. It doesn't help it in any way because it doesn't change the prices it extracts from any of the other transactions that it includes, okay? So first price auctions have MMIC, but they're not truthful. The VCG mechanism is truthful, but it's not MMIC, okay? So the question is, can we get both of them? All right, so let me start brainstorming about what else could we try other than just a first price auction or a second price auction. What's the transaction fee mechanism design space look like? Well, another thing we could try is we could try to use a reserve price, okay? Meaning a price floor. So we could have a lower bound on the minimum bid we'd be willing to accept from anybody. Okay, so call that R, all right? So to be clear, transactions who are bidding less than R are just ineligible for inclusion in the block. They would be an invalid transaction under this, what I have in mind is any transaction with a bid less than R on chain would be regarded as invalid, okay? Now, if you have, lots of transactions who are willing to pay R, then you'd have to sort of make some selection. Let's not worry about that for the moment. And then the payment's just going to be R. Okay, you're just going to charge everybody this one common price, and then fill up the block as much as you can with people willing to pay that price. So that's a natural idea. Reserve prices are very common in auction theory and in auction practice. But here we see, yet another challenge coming from the permissionless blockchain setting. right? So we talked about deviations by users. They can sort of give you non-truthful information. We talked about deviations by miners. Okay, they can sort of mess around with the allocation you have in mind and submit fake transactions. This final issue is collusion. Okay, is a miner of a block and creators of transactions in that block forming a cartel and colluding off-chain in some way that benefits them. Okay, and so, for example, such cartels can be used to completely evade the point of one of these reserve prices. Remember, the reserve price is meant to keep away low-value transactions, transactions that are not willing to pay the reserve. Okay, so here's how a miner and users could completely evade it. Okay, suppose the current reserve price is, say, like 100 gwei. So the intention of the mechanism is that if you're not willing to pay 100 gwei, you're not going to get on the blockchain. Okay. Let's suppose also that all of the pending transactions, their creators are not willing to pay 100 gwei. Maybe they're only willing to pay 60 gwei. Well, then they can just, off-chain. So basically what they can collude and do is the users will bid 100 gwei on-chain anyways, even though they're not willing to pay that. Okay, but that's enough to sort of get the mechanism to assent to including these transactions. They'll be eligible. And then the miner will pack the block with those transactions. The miner will collect the reserve price, the 100 gwei for each unit of gas, and then it'll refund off-chain the remaining 40 gwei per unit of gas back to the transaction creators. Okay, so you trick the blockchain into thinking that these transactions really were worth 100 gwei, but in fact they're not, and that gap is corrected for by a refund from the miner back to the transaction creators off-chain. Okay. So having a reserve price is a natural idea, but this didn't work. Okay, this can be evaded through these off-chain agreements between a miner and users. And so that's going to be the fourth and final challenge. Okay, this sort of off-chain collusion. I mean, this is not hypothetical. I mean, there's forms, there's different things which can basically be regarded as doing this right now. Okay, obviously, smart contracts make this a lot easier to pull off than in a lot of traditional mechanism design settings. So the third incentive guarantee we're going to have, remember we had DSIC, which is the same as truthfulness. We had MMIC, which is that miners shouldn't be incentivized to do anything weird. And then we're going to have OCA proofness. OCA here stands for off-chain agreements. And this definition just says it should not be the case that miners and users can sort of form a cartel and do off-chain transfers so that they're all better off. Okay, so we just, again, I've set up this, I gave you the non-example before the definition, so it's clear what this definition is trying to rule out. Okay, so the reserve price that we just looked at, that type of mechanism would not be OCA proof because we saw that off-chain they can improve themselves. Okay. All right, good. Now, if you think about it, a first price auction, so the status quo, it didn't satisfy DSIC, it wasn't truthful. It did satisfy MMIC, as we saw, because miners are happy to just maximize their revenue and pack a block with the high fee transactions. First price auction is also OCA proof. Okay, there's really nothing users and a miner can do off chain that they couldn't do on chain, right? Whatever agreement, whatever payments they were going to arrange off chain, you could just bid those payments directly on chain. It would be exactly the same outcome. Okay, so there's really not a reason for these off chain cartels of first price auctions. And so then, I hope, so I've set this up, right? So here are the challenges reviewed. And again, I've shown you these sort of formal definitions. Again, truthfulness or DSIC, MMIC, OCA proof. We've seen several auction formats, none of which satisfy all three, right? First price auctions are not truthful or not DSIC. Victory auctions and VCG mechanisms are not MMIC because fake transactions help miners. And the reserve price-based mechanism is not OCA proof because of the sort of evasion of that reserve price. So the obvious question now is, can we have the best of all worlds, right? Can we really have sort of the strengths of first price auctions simultaneously with second price auctions? Can we be DSIC, MMIC, and OCA proof all at the same time? Okay. All right. So before I sort of, so where we're going is I'm going to tell you about EIP-1559, and we'll sort of assess to what extent it satisfies those three properties, those incentive guarantees that I'm after. Before that, I mean, let me just say, like, so it's sort of been all bad news so far, at least to the mechanism designer, right? The mechanism designer, we have this toolbox, and basically I just spent 20 minutes saying all these reasons why the toolbox doesn't really immediately apply. So let's try to put a more positive spin on it, and let's kind of say, well, is there anything special about the blockchain setting which actually helps us as mechanism designers, which makes our lives easier, okay? And there are, actually. Because each of these auctions for a block, it's not just a one-off auction happening in the vacuum. There's been lots of auctions, there's been lots of blocks that have preceded it. There will be lots more auctions for blocks that come later. And that opens up some opportunities, actually. So for example, the mechanism you use for a given block. So for example, what reserve price you try to use, that could depend on the past, on blockchain history. Okay? First price auctions do not make use of this power. First price auctions are, just ignore the past and the future. But you could, if you wanted, have a past dependent mechanism used at each block. And in fact, EIP-1559 will be of that type. Okay. The second benefit goes back to this fact that the way that the payments work are completely hardwired into the protocol, okay, which gives us a lot of flexibility. In the status quo, transaction fees are automatically transferred to the miner of a block, but there's no reason the protocol necessarily has to do that. That you could do other stuff with the user's payments if it wanted. For example, it could burn the user's transaction fees, meaning take that ether and remove it from circulation, so sort of deflationary pressure, or you could redirect it elsewhere. So for example, to miners of future blocks, if there was a reason to do so, and actually we'll see shortly, there's a very good game theoretic reason to sort of send some revenue not to the miner of a block, but either to burn it or to send it to miners in the future. Okay. So that means we're actually going to be looking at three things, not just an allocation rule X, a payment rule P. P, that goes to the miner. We're also going to have another burning rule Q, which just, that's sort of fees from the user paid by the users that do not go to the miner of a block, for example, are burned or sent elsewhere. Okay. So this is now all of the setup, right? So the question I want to ask is there a way to choose X, P, and Q so that we get those three incentive guarantees that we want: DSIC, MMIC, and OCA proof? And also, given that EIP-1559, is actually going to probably be deployed, to what extent does that particular choice of X, P, and Q satisfy these incentive guarantees? Okay. So that's all of the setup before I want to sort of now specialize the discussion to EIP-1559. Any questions to this point?
So there is a question in the chat.
Yeah, so Luciano asks, I don't understand why we can't just put the two highest bids on the block and make the second price auction on chain. So that's a great comment. I think that's a very natural response. The immediate issue, one minor thing is you don't really want to waste the scarce block space on metadata, which sort of you don't need. But the much more sort of important response is the problem is then that second highest bid could be faked by the miner, right? So the miner, because the point is, presumably what you have in mind, the person who submitted the second highest bid doesn't actually have to pay anything, right? Like in a real second price auction. And so that means the miner has no skin in the game. The miner can just submit that transaction, but basically set its bid to be epsilon less than the top bid. It's not on the hook for paying it. Meanwhile, it'll boost its revenue and it'll basically extract the full bid from the winner. So it'll basically be a first price auction. So that's the reason why that doesn't work. So Christian asks, have we ever seen this model before in some other context? So the setup of allocation and payment rules, that's very standard in mechanism design. Mechanism design, you do study money burning at times. I have a paper 13 years ago now where I was talking about money burning in a different setting. It's unusual. I don't know that I've seen a mechanism design application where you really had non-trivial payment and burning rules at the same time, and you sort of needed both, which is what we're going to have here. So that may be novel. The DSIC or truthfulness property is obviously very standard in mechanism design. The MMIC definition is new, although it does resemble something that's been happening in mechanism design theory the last few years known as credible mechanism design, which again is sort of focused on untrusted mechanism implementers. And then OCA proofness is again, basically novel in a mechanism design setting. Traditional mechanism design applications, you really tend to not be worried about these cartels between the seller and the buyers. It's usually kind of a, almost a zero-sum game between the two. No problem. Other questions before I move on? All right. So now we know what we want. We want a transaction fee mechanism that's DSIC, MMIC, and OCA proof. To what extent does 1559 fit the bill? All right. Well, let me tell you what it is. Okay. So again, this is a proposal developed by Vitalik Buterin, the founder of Ethereum. And so let me tell you exactly how it's going to work. It's actually several changes all at the same time, several interlocking changes to the transaction fee mechanism. The goal, again, remember, is to make it much easier to figure out what to bid, what fees to set for Ethereum transactions. So we're going to use, there's going to be three key ideas. I'll walk you through one at a time. The first key idea is an idea, it seems like we already shot down. it seemed like it didn't work, which is we're going to have a reserve price, which in 1559 is known as a base fee. Okay, so base fee just means a reserve price. And again, it just means that transactions that bid less than the base fee are ineligible for inclusion in a block. They're just not allowed. Okay. Now, that didn't work. Remember, it was evaded by this off-chain agreement. So so that game theory is going to dictate that we do something with the base fee revenue other than pass it on to the miner of that block, which is what we tried before. Okay. When that revenue gets passed on to the miner of that block, it stays in the system. It stays amongst the cartel of the miners and the users. And so they were just able to reshuffle it to make them all better off. So importantly, we need the base fee revenues to go outside of a potential cartel of the miner of this block and of the users. Okay. So there's various ways you could do it, but the plan in EIP 1559 is to burn the base fee revenues. Okay. And as we'll see, that's going to fix the problem. We actually will be able to get OCA proofness because the base fee is burned, or at least, or in some other way not given to the miner of the block. Okay. So that's the first really important thing about the base fee, is that it gets burned. The second really important thing is that it is computed as a deterministic function of the blockchain's past. Okay. So there is no way that the users in a block or a miner of a block can in any way influence the base fee of that block. Okay, that base fee is already fixed by what's happened in all of the predecessor blocks on the longest chain. Okay, so it's a history dependent and present independent base fee, all of the revenues from which get burned. Okay, so that's idea number one. Now, an obvious question is, so what's the base fee? How are we going to compute the base fee? Well, before answering that question, let's think about what we would want. So suppose suppose a base fee fell from the sky. All right. What base fee would we really like to have? All right. And in this context, for economic efficiency, which is what we're after, what you'd like is something called a market clearing price. And so what that means, you would like the base fee R to be so that exactly 15 million worth of gas of transactions. Remember, 15 million is the block size. That's how much you can pack. So that exactly 15 million gas worth of transactions are willing to pay the base fee R. Okay, because then what would be the results? The block would be fully utilized, and you would have perfectly differentiated between the 15 million most valuable gas of transactions in the mempool and the rest. Okay, which is again exactly what you want. You want the scarce resource to be fully utilized and utilized solely by those who get the most value for it. Okay, so that's the holy grail. The holy grail is to have the base fee equal to this market clearing price. All right, but so how do we actually how do we actually compute that market clearing price? It's not falling from the sky. And a natural idea is to use local search, basically, kind of hill climbing. Where you say, well, let's just sort of look at what's the demand at the current base fee. If the demand's too high, then we should increase the price. And if the demand is too low, then we should decrease the price, right? So for example, right, suppose we have a base fee of 100 GUE, and we look at it, and in the most recent block, it's only 2/3 full. Okay, it only has 10 million gas worth of transactions in it. We could probably say that as well, wow, we couldn't even fill a block with transactions willing to pay 100 GUE per unit of gas. So I guess we should use a lower base fee, right? So maybe let's try 90 GUE for the next block and try to get the blocks more full. So that's very natural. If you see blocks that are under full, decrease the base fee. But the other direction is trickier, right? Like, how do you know if you should increase the base fee, right? So suppose you see a block that's totally full, okay? No room at all. The issue is you cannot differentiate between, on the one hand, the fact that you may have the base fee exactly right, and maybe exactly the market clearing price, and there's no reason to change it at all, or scenario number two, in which your base fee is way too low. And so the reason the block was full is actually because not only did 15 million gas worth of transactions be willing to pay that base fee, 25 million were. Okay, you do not have an on-chain record of the 10 million gas that was not included. So you cannot, from on-chain information, differentiate whether whether the current base fee is perfect or whether it's too low. So that brings us to key idea number two, which is post 1559. Actually, the Ethereum protocol will have more flexibility in how it allocates block size. Okay, so right now there is a per block maximum of 15 million gas. Okay, now in practice they're almost all full, so it also means kind of the average throughput, if you like, is 15 million gas per unit per block, say per 13 seconds or so. And so post 1559, we will keep the constraints that the average throughput is what it is now. Okay, so on average 15 million gas per block per 13 seconds. However, we will allow the blocks to have different sizes. Okay, up to a cap, we got to keep things under control. So we allow the blocks to go up to 30 million gas. Okay, but mind you, whenever blocks are published that are more than the target size, they're going to need to be compensated for with future blocks that are under full. Because again, the average throughput, we want to keep at 15. We're just going to allow fluctuations in the block size. Notice this immediately solves the problem we had with implementing local search for the base fee, right? So as before, when we have a block that's under full, less than 15 million gas, we know we should decrease the base fee, okay? On the other hand, now we also know when we should be increasing it, right? If we see a block that's exactly 15 million, now we'd actually know that the base fee is exactly right. It's the market clearing price at a supply of 15 million gas. Whereas if we see a block that's bigger, the miner actually used this extra real estate, say it's 20 million gas, then we know the base fee is too low and we should move it upward a little bit, okay? So variable size blocks, they have some other benefits as well I'm not going to get into, but they immediately solve this problem where they give us an on-chain signal of whether to increase or decrease the base fee. And so now really we can just, block by block, keep searching for the best base fee. The base fee that's this market clearing price where you get sort of 15 million gas worth of transactions willing to pay it. Okay. The formula, here's the specific formula for how it changes. This won't be important for our talk, but just in case you're curious, I decided to put it on a slide. So basically, if in the two extreme cases, if you have a double full block, a maximum block, then the base fee has to go up, and it goes up by 12.5% for the next block. If you have an empty block, then the base fee drops by 12.5% for the next block. And anywhere in between, you just linearly interpolate. Okay, so this is this constant adjustment upward or downward, depending on whether the block sizes are above or below 15 million gas. Okay. All right, so those are the first two key ideas: base fee that's history dependent and burned, and then these variable size blocks to provide an on-chain signal of excess demand. And so there's one more idea. Okay, key idea number three, and that's motivated by two questions you might have. Question number one is, so wait a minute, like the base fee, we're not burning it, we're not giving it to the miner. Why should miners mine blocks? Well, okay, I guess there's still the block reward, right, of 2 ETH per block. That's still going to go to the miner post 1559. So miners actually are incentivized to mine blocks, but then you would say, well, okay, but why don't they just mine empty blocks, right? They have no incentive to actually include transactions because the transaction fees are being burned. So that's a very reasonable question, number one. Question number two is, well, what if you find yourself in some crazy case where your base fee is just like totally wrong? It's like way too low. And so there's just more than 30, even with a double full block, you cannot accommodate everybody who'd be willing to pay the current super low base fee. What do you do? How do you mediate that hopefully edge case? So those two questions have the same answer. This is key idea number three, which is that 1559 is going to include, basically there's going to be kind of a emergency first price auction mechanism layered on top of this demand dependent base fee. Okay, So the language used in 1559 is that miners have tips, okay, and those really play the same role as sort of gas prices do right now. Okay, so the tip is going to go to the miner. The tip is not going to be burned. So the way this is actually going to work is that transaction, when you submit a transaction, you have to submit 2 parameters. So currently you submit 1 parameter, a gas price. Here you're going to be submitting 2 parameters, the tip, and that's sort of a promise. So that again will be directed to the miner of the block that includes you. But also, when you submit your transaction, you don't know how the base fee is going to evolve. And so it's important you can protect yourself and say what the maximum willingness that you're willing to pay is. And that's known as the fee cap. Okay. But again, for a typical user, unless you're kind of, super time sensitive, really the tip, as we'll discuss, that's just going to be some small nominal number. And then, you should just set the fee cap to your maximum willingness to pay. For example, maybe, in principle, you'd be willing to pay a lot. You'd be willing to even pay like 200 gwei gas price. Okay, so that's the base fee that you're willing to tolerate. And then the tip, let's say, you just give the miner something nominal, so they'll include you in a block, like 2 gwei or something like that. So you might be paying up to, the worst case for you is that there's a base fee of 198 gwei, and you wind up paying your full fee cap 200. Okay, 2 to the miner, 198 of which gets burned. But hopefully, when you show up, the base fee will be a lot lower than 200. Maybe the base fee will only be 120, and then you're not going to be paying 200. You're just going to be paying 122. Okay, 120 the base fee, which is burned, plus the 2, which is the tip for the miner, which gets transferred to the miner. Okay, so that's how it works. You submit a fee cap and a tip, and that automatically induces your bid with respect to whatever the base fee happens to be right now. Okay, so basically you're going to be paying the base fee plus the tip, or the fee cap but up to a maximum of the fee cap. Okay. All right, and when I get to this final part of the design, often I get a very disillusioned response, right? Because I talked about how currently it's first price auctions, and aren't they terrible, and don't we need something better? And now we're in the situation where, wait a minute, you're saying there's actually a first price auction in 1559. So here's the hope. And hopefully, once it's deployed, we'll see this play out. But this is the hope of what's going to happen, right? The hope is that the base fee is usually pretty good. Okay, maybe it's not perfect, maybe it's not market clearing price, maybe it's not 15 million gas willing to pay it, but maybe it's somewhere between, say, 10 and 20 million, something like that. Okay. Then the thing to notice is that actually you don't have to engage in the first price auction, right? If the base fee is a little low but not too low, so that there's only 20 million worth of gas willing to pay it, then the miner, right? The miner can go up to 30 million if it wants. So actually, the miner will just accommodate literally every single eligible transaction. All 20 million gas worth of transaction that are willing to pay the base fee are going to get included. So you don't have to worry about your tip. You don't have to worry about the first price auction. Just set something nominal, and you should be fine. Now, there will be these sort of cases, which hopefully is just like 1% of the time, where all of a sudden the demand went way up. So the demand was like low for a while, and then there's this sudden sort of spike in demand, like there's an ICO or something like that. Now, long term, I mean, even in the term of like 5 minutes or something, everything's going to be fine, because there'll be some blocks that are sort of like way oversubscribed, and that'll drive up the base fee, and then the block, then the amount of transactions willing to pay it will sort of drop back down. But there will be this transition period of a half a dozen or a dozen or 20 blocks, something like that, where the base fee is just too low. Okay, and in that case, the good news is, so first of all, hopefully this is going to be rare. This is going to be like 1% of the time, and what does it do? It sort of gracefully reverts back to the status quo. Okay, so hopefully 99% of the time this mechanism is much easier, and then 1% of the time it's no worse than things are right now. Okay, so that's the hope. So I see that George has asked me to finish in about 5 minutes or so. So I'll do my best. So let me try to. I do want to sort of finish the story, but I'll try to move with a light touch. Okay. Any questions on 1559, by the way? So this is how it works. These are all of the key points. History dependent base fee, right? So miners and users cannot manipulate it in the current block. That's very important. Very important. The base fee revenues are not given to the miner of the block. Here they're burned. The game theory. Remember the game theory. It says otherwise you can evade it. We have this variable block size that gives us the on-chain signal of whether demand is too high or too low. And then we have these tips just to kind of give a little bit of incentive to the miner and give kind of very impatient people a lever to use when in the 1% of the blocks where the base fees way too low. Okay, so let me now tell you the punchline, right? So I told you the 3 incentive guarantees that I wanted to use to sort of assess various transaction fee mechanism designs. So the DSIC or truthfulness property, the MMIC property, like miners shouldn't want to submit fake transactions, et cetera, and OCA proofness, that miners and users can't collude off-chain to sort of cheat the protocol. Good. Yeah, so so good. Let me skip that. So let me get to the points. Yeah, so point number 1. Did I skip one? Yeah, okay, sorry, here's the first one. So the first 2 claims are just that EIP-1559 satisfies the same 2, at the very least, it satisfies the same 2 properties as first price auctions. Remember, first price auctions, their big fail was truthfulness, but on the other hand, they were incentive compatible for myopic miners, right? There's no reason for miners to deviate from the revenue maximizing strategy. And also there was no point including off-chain, because whatever you do off-chain, you could just simulate on-chain. Okay, so first price auctions are MMIC and OCA proof. And then we can just quickly verify that that's true also for the 1559 mechanism. Why is it MMIC? Basically for the same reason as first price auctions. I mean, the difference is there's this base fee, but the base fee is burned, right? The miner can't do anything about that. The base fee is a function purely of the past, so it can't change what the base fee is. So that's just sort of money that it cannot get access to. So all the miner can really manipulate is sort of what is the tip revenue that it gets. And so we're just expecting the miner to pack the block as full as possible with eligible transactions to maximize the sum of the tips. And that's exactly what the miner is happy to do, just like it's happy to maximize revenue in a first price auction. So it's MMIC for roughly the same reasons as before. It's also OCA proof. Okay, OCA proof, remember, is what we did not have when the base fee was not burned. Okay, and so it's very important that the base fee is burned. It's important that the miner and users cannot manipulate what that base fee is. And then for more or less, the argument here is a little more subtle, but along the same lines of a first price auction, you get OCA proofness for the 1559 mechanism. And I'll have to skim over the subtle details there. So here's the interesting thing, right? So the reason we're rejecting first price auctions is because of their non-truthfulness. And so the point of EIP-1559 is to restore truthfulness in some sense, okay? So that's really the question. This is really what you should be wondering about. Is the 1559 mechanism a DSIC or truthful mechanism? But if you think about it, I mean, without conditions, the answer is obviously no, right? Because it actually includes as a special case a first price auction. The base fee is 0. It's literally a first price auction, which of course is not at all truthful under kind of any circumstances. Okay? But your reaction should then be okay, but that's kind of weird, right? Why is the base fee? The base fee would only be low if literally nobody was using the blockchain. If nobody was using the blockchain, you could just set your tip to be roughly 0 anyways, and it wouldn't matter, right? So this seems like an uninteresting case. So it seems like a minimal condition we would need to have a truthfulness property would be okay, well, we can't have a crazy low base fee, okay? By crazy low, I mean, remember, we're shooting to have a base fee where 15 million gas worth of transactions are willing to pay it. By excessively low, I mean more than double that are actually willing to pay it. So we're way off, we're way too low. So excessively low means that more than 30 million gas worth of transactions are willing to pay the current base fee. Okay? And that seems like a necessary condition to get a truthfulness property. Because if you don't have that property, then in fact, you really are competing with other people through the tips mechanism. All right, so we need one more, again, very palatable assumption. So the one other thing which can technically go wrong, although you would never expect this to actually happen, which is if for some reason users overbid, meaning they set their fee caps to be bigger than what they really would be willing to pay. And you never want to do that. It's a dominated strategy. But if for some reason all the users were crazy and overbid, then even though you kind of have the right base fee for what people are really willing to pay, somehow on chain, it looks as if you have a super low base fee, because on chain, you see these bids that are super high, right? So lots of people are willing to pay your base fee, but the only reason that it looks like they're willing to pay the base fee is because they lied on chain about what they're willing to pay. So that's more of a technical detail. Okay, so technically it's not true. The only assumption is that that the base fee is not excessively low. You also have to assume that users don't overbid. And again, there's no reason you would ever overbid, but in principle they could. So you need to assume that they don't overbid. And the good news is those are the only 2 obstructions for the EIP-1559 mechanism to be truthful. Okay, so if you assume, first of all, that the base fee is not excessively low for the current mempool, meaning 30 million or less gas worth of transactions are willing to pay the current base fee. And furthermore, no one was crazy and set their fee cap to be more than what they're willing to pay, then in fact, truthful bidding is utility maximizing for every user. You should literally just set your fee cap equal to your maximum willingness to pay. So you really do recover the exact same cognitive simplicity that you have in a second price auction. But again, we were able to do this without sacrificing either OCA proofness or the MMIC properties of the current first price auctions. Okay, so that's the ultimate punchline. We keep the same two properties of first price auctions, and we recover most of what we like about second price and BCG mechanisms, with these caveats that the base fee has to be not too crazy and users can't be acting too crazy. Okay, so this is the punchline. So first price auctions, very simple, but they're not DSIC, and they do not take advantage of the unique benefits of the blockchain setup, right? The current first price auctions, they don't look at the past, they don't think about burning, they don't think about the future. So really the takeaway for EIP-1559 is you restore most of the benefits of the VCG mechanism without giving up anything. And the way you do it is by taking a crucial advantage of these extra levers you have in the blockchain setting, right? So you have a past that allows you to set a pretty good base fee for right now. And then you also have this ability to redirect those payments to someone other than the person executing the mechanism. So burning those base fee revenues, okay? So that's the big difference. It's more complicated, but it takes advantage of these sort of extra parts of the design space in a blockchain setting, and it actually does give you a game theoretic win in having a DSIC most of the time. I'm going to skip over the alternative designs. The first one just says instead of burning, you could pay the base fee revenues forward, the miners of future blocks. The game theory would be exactly the same. Second one is just instead of having users specify tips, you could hard code those tips, and that gives you even stronger truthfulness type property. On the other hand, you give up a little bit on OCA proofness when the base fee is excessively low. Okay, I'm gonna wrap up now. I'll leave these three open questions on the slide. I'm happy to take questions about them, but I'm out of time, so I think I'll stop here. So thanks very much.
Thank you so much, Tim. So I think we are running a little bit out of time. There is one, we take just one question. It is asked in the chat by Oguzan. If we assume that miners can control couple of consecutive blocks, then is EIP-1559 still MMIC?
Right, that's a good question. So MMIC sort of by definition is about the time scale of a single block, which is restrictive. But notice there's already a lot of things that can go horribly wrong on the time scale of a single block. Right? We saw that second price auctions break down even in a single block. Their initial reserve price idea broke down even in a single block. So all of these guarantees are just for the single block case. So in other words, when I'm talking about MMIC, it's a miner that is not contemplating the possibility of sacrificing revenue in this block in exchange for potentially higher revenues in future blocks. Again, that's just not part of my game theoretic model. It's a very good question. You notice this is sort of this is more or less getting at the second open problem I've listed on the slide. In sort of the long, I have a 58-page report about EIP-1559 written for a general audience, and there's a long section discussing qualitatively the game theory of miners sort of manipulating the protocol over a multi-block timescale. But it's, at least by my standards as a theoretician, it's quite informal. It's really just a qualitative discussion. And I would love to see sort of a really rigorous way of saying that, you know, whatever the collusion possibilities post 1559, they're really no stronger. This is my belief, this is my conjecture, that, you know, miners could collude now in Ethereum. For the most part, they don't. And my conjecture is that, you know, whatever it is that's preventing them from colluding now should still prevent them from colluding post 1559. And I give sort of qualitative arguments for why that might be true in the report. But I'd love to see, you know, I'm a theoretician, so I'd love to see some math that actually backs that up. But, you know, in the interest of time, let me just sort of say, you know, check out the full report if you want to understand more of this sort of multi-block time scale. Then there's a full like eight page section that discusses it.